So the AI boom, I mean, it's rewriting the economic rulebook faster than we can possibly keep up.
It really is.
And when you look at the sheer velocity of it,
Mm.
the demand for chips, the power needs, which are just city scale now, all that corporate investment.
Right.
The question isn't just if it's going to change productivity. I think we're past that. It's how the wealth that comes out of it is going to be distributed.
That's it. Is this a huge technological bonanza, or are we just watching the next massive financial bubble?
Bonanza versus bubble.
Exactly. And that distinction is precisely why we did this deep dive. To get a real sense of the AI era, you can't just compare it to the dot-com boom.
Which was mostly speculative enthusiasm.
It was. You have to look back further to the Industrial Revolution because that was a fundamental societal phase change. Our sources today help us separate the hype from, a real structural transformation.
So the mission is clear. We want to know if the AI story follows that familiar pattern where investors get burned, but society wins in the end.
Right, the investors lose, society wins model, or if this time is different, if AI represents a complete structural break from that history.
And the timeline alone is just staggering.
Absolutely. The Industrial Revolution, that was a slow burn. Mid-18th to mid-19th century, it was a compounding, decades-long process of mechanization.
Then the dot-com era. An explosion of connectivity, super fast.
But AI, this is built on LLMs and GPUs, and it's characterized by this unprecedented speed. We're moving into an age of cognition in what feels like just a few years.
The speed alone forces us to look at it differently.
It does.
Okay, so let's unpack this by starting where it all began, really.
Yeah.
The Industrial Revolution. It wasn't just one invention.
No, not at all. It was a layering of breakthroughs, new materials like iron and steel, and of course, new power, steam and coal. You see this compounding effect so clearly in textiles.
Right, the flying shuttle, the spinning jenny.
Exactly. The flying shuttle in 1733, the spinning jenny in 1764, then the water frame, the spinning mule. They didn't just automate a few tasks.
They completely changed where work was done.
They forced the shift from people's homes into the centralized factory system, and that infrastructure then enabled everything else.
Including the very first hints of modern computing. It's funny, we often forget that the steam engine, James Watt's big improvements, was actually necessary for Charles Babbage's whole vision.
That's such a key point. His difference in analytical engines in the 1830s, these were just massive, incredibly complex mechanical calculators.
And the sources point out his big one, the analytical engine, would have needed an actual steam engine just to power it.
That's the connection right there. Industrial power was driving computational ambition. But if we shift from the machines to the economics, this is where we find the first real historical paradox.
Okay, so tell us about this, the strange economics of that period with all this growth, but also massive inequality.
Yeah, the macroeconomic data from Britain is, well, it's pretty startling. Between 1800 and 1840, you see output per head, which is, a key measure of productivity.
Like a classic metric.
It just soars. It goes up by 37%. But, and this is the crazy part, real wage growth for the actual working population.
And Macedon up too, right?
It showed nearly zero, just negligible growth.
Right.
Over 4 decades.
That feels completely broken. If the economy is growing by more than a third, why aren't wages moving?
Yeah.
Who was capturing all that new wealth?
It was accruing almost entirely to non-workers, so the owners of capital and land. The share of national income that actually went to labor fell from 60% in 1770 down to 47% by 1860.
So for generations, the Industrial Revolution meant productivity shot up, but wages stayed flat.
That was the defining feature.
And that brings us to the sovereign debt paradox.
Yeah.
This is the real aha moment in the sources, and it's so counterintuitive.
It really is. Britain had this huge sovereign debt from financing all its foreign wars. You'd think that would cripple the economy.
But to the opposite.
It accelerated industrialization. Here's how. The government debt was packaged as these highly liquid bonds and consols. They were secure, easily traded, and very attractive to the wealthy nobility.
So instead of investing their money in, say, improving their farmland, which might give them a return of less than 1%.
Right, like draining a swamp.
They just poured their capital into these safe government bonds instead.
Exactly. And these consoles acted like a huge magnet, pulling capital away from the old, low-productivity agricultural sector. That moved naturally depressed labor demand in those older sectors, and it pushed down wages across the entire economy.
And the new industrialists?
They often self-financed, and because labor was so cheap, their profit rates were huge. They just reinvested those profits and scaled their high-productivity industries even faster.
So just to translate that for today, The stability of government debt basically starved the old economy of capital, which then made it way easier for the new high-tech industrialists to grow.
That's a perfect summary.
A parallel we have to watch for now is all the venture capital drying up for everything that isn't AI because
Ugh,
the potential returns there are just so much higher.
it's a vital structural comparison to make.
Okay, let's pivot from that slow burn revolution to the absolute financial firestorm of the dot-com bubble.
A completely different animal.
What was that frenzy like, and how does today's AI boom really compare on a financial level?
Well, the dot-com peak back in early 2000 was defined by speculation that had completely lost touch with reality.
With the fundamentals.
Totally. If you look at the big four tech leaders back then, Microsoft, Cisco, Intel, Oracle, they were trading at around 70 times their 2-year forward earnings.
Okay, let's just define that. A PE of 70x means you're paying $70 today for every dollar of profit you expect the company to make 2 years from now.
You're pricing them for absolute perfection and then some. And of course, the crash followed. Their net income dropped by a staggering 65% in 2001.
And the capital spending, the CapEx, was just wild.
It was fueled by questionable IPOs and even outright fraud. Like WorldCom inventing over $11 billion in demand for fiber optic cables. It created this huge overcapacity and unstable market.
So when we look at the AI boom today, the financial picture is very different.
It is, and it's mostly about who is driving the investment. Today, the biggest spenders on AI data centers are the hyperscalers.
Microsoft, Alphabet, Amazon, and Meta, the big four cloud providers.
And they're trading around 26 times their 2-year forward PE.
Okay, so that's less than half of the dot-com extremes. It's not cheap by any means, but it's not a completely irrational bubble.
Not in the same way. These are companies with incredibly strong fundamentals and cash flow, and they're expected to grow earnings by 17% next year.
And that leads to the biggest structural difference in how this is all financed.
The capital spending is highly concentrated. In the dot-com era, every little startup had to raise money to buy its own servers. Today,
You just rent compute capacity by the minute or second from one of the hyperscalers.
exactly. So the massive financial risk is concentrated with just a few huge players who have the balance sheets to handle it.
Yep.
The whole system is less fragile than it was in 2000.
But the skeptics are still out there.
Oh, absolutely. And their main argument often comes back to that picks and shovels analogy.
Comparing NVIDIA to Cisco back in the day, the essential infrastructure provider.
Right. And the argument is, what if the fundamental direction of AI, let's say large language models, turns out to be a dead end? Then all the billions spent on the current generation of GPUs could be wasted capital.
And we're hearing some specific financial warnings too, especially in the private markets.
That's where the real bubble factor seems to be. The sources flag concerns about these sort of circular deals.
Like NVIDIA giving money to OpenAI.
A major customer with negative cash flow, so that OpenAI can then just turn around and buy more GPUs from NVIDIA. It pumps up the revenue numbers, but it's structurally pretty questionable.
And the private valuations for companies like OpenAI are just absurd.
Getting close to $500 billion, even though they expect huge operating losses, that is where you see the pure dot-com style exuberance.
So moving from financial risk to physical limits, the infrastructure for this cognitive revolution is just mind-boggling, especially the energy demands.
The speed of that demand is what's unique. The critical power needed for data centers globally is set to hit 96 gigawatts by 2026.
And AI is a huge chunk of that.
AI operations alone could eat up over 40% of that critical power. The annual power use from AI data centers is expected to reach 90 terawatt hours by 2026.
Which is a tenfold increase from 2022.
Tenfold. In the U.S. alone, data centers might be 6% of the country's total electricity use in just a couple of years.
Just to put 90 terawatt hours in perspective, that's about the same amount of electricity a country like Belgium or Sweden uses in a year.
It's massive, and it raises the question of efficiency. We hear that computing power per dollar doubles every 3 years. Shouldn't that help?
You'd think so.
But we're seeing the Jevons paradox in full swing. The principle is that as a resource becomes more efficient and cheaper, we don't use less of it. We use way more of it.
So even though each individual chip is more efficient,
The demand for training these models has grown 1,000-fold in just the last few years. So the total energy needed just skyrockets, and it overwhelms any efficiency gains from a single chip.
and how are we supposed to meet that demand?
In the near term, the next 2 to 5 years, it's going to be natural gas, turbines and engines that can be deployed quickly. Grid-scale nuclear is more of a 5 to 10-year solution.
This whole issue of infrastructure and who owns it brings us to what might be the biggest difference between the AI era and every revolution that came before it.
This is the core of the argument.
In past booms, like railroads or electricity, even if monopolies formed, society eventually benefited because those monopolies couldn't capture all the value.
That regulatory firewall was absolutely key. Railroads charged regulated fixed rates. Utilities charged you by the kilowatt hour.
Right. Your electricity company didn't get a cut of your factory's profits.
No. That meant the economic benefits of the new infrastructure eventually diffused broadly across the whole economy.
So what's so structurally different about AI that might break that historical pattern?
The structure is vertically integrated, and the pricing mechanism is completely different. The hyperscaler coalitions, like Microsoft and OpenAI, they use uncapped, usage-based API pricing.
They're not just selling you bandwidth or electricity.
They're selling you cognitive tokens.
So if I build a wildly successful AI app that makes billions, the hyperscaler who owns the infrastructure gets an uncapped, continuous slice of my profits through my token usage.
That is the structural break. This mechanism allows the few concentrated infrastructure owners to just keep capturing the surplus from the application layer as it scales. And that's what might actually justify their massive capex.
A power that past infrastructure owners just never had.
They were constrained by those volumetric rates.
So this concentration of control over the infrastructure and the ability to capture value downstream, that's where the idea of structurally mandated inequality comes from. The benefits get centralized, not diffused.
It could fundamentally break that historic investors lose, society wins dynamic.
Let's turn to the human consequences. How is the labor market actually reacting, and how are our laws even beginning to grapple with this?
On the labor side, the effects are already real. We're seeing that jobs needing AI skills have a significant wage premium, up to 25% in some cases.
And they're growing faster.
3.5 times faster. And maybe most importantly, sectors that are exposed to AI are seeing nearly 5 times greater labor productivity growth.
Now, historically, technology replaced routine, lower-skilled jobs. But AI seems different.
That's right. AI is exposing higher-paid, more educated workers doing non-routine cognitive work, like writing code or legal documents. But, we should be a little cautious about immediate panic.
Okay.
The sources are clear that the overall shift in the mix of jobs since ChatGPT came out isn't markedly different from what we saw during, say, the early internet era. Not yet, anyway.
So the skill of human judgment is still king. Which brings us to this intern-expert dynamic.
Yeah, this is so critical for the future workforce. And AI can do entry-level tasks incredibly fast, but it has a huge flaw. It can BS or hallucinate.
Right. It can be confidently wrong.
And knowing whether the output is actually correct, that skill remains incredibly valuable.
Which suggests that the experienced worker, the expert with real judgment, might be safer. But how does an intern ever become an expert if all their training tasks are being automated?
That's the billion-dollar question. It suggests the whole structure of training and apprenticeships will have to change. Maybe we shift away from the firm-based internship model.
And move it into education itself.
Potentially. Reorganize education to focus on critical thinking and judgment before you even enter the workforce, because those early tasks that built experience are now done by a machine.
So if AI is creating all this intellectual value, who actually owns it? This throws intellectual property law right into the spotlight.
It really does. IP law has basically become the new labor law for the cognitive age, and the courts are struggling.
How so?
They're trying to apply these very human-centric laws to machine creativity. The key U.S. case, Thaler v. Hirschfeld, ruled that an AI system cannot be an inventor under the Patent Act.
Because an inventor has to be a natural person.
Right. And the same principle holds for copyright. If a work is purely AI-generated with no significant human creative control, it's not eligible.
So the courts are trying to keep humans in the loop, but that still leaves the huge economic question wide open.
Exactly. How do you distribute the profits from the cognitive labor of a non-human? That is the governance gap we're facing.
And on top of that, there's the ethical dilemma of biased data.
A huge one. AIs trained on historical data can smuggle in biases and just perpetuate inequality. The classic example is the Amazon hiring tool that downgraded women's resumes because historically, most successful applicants had been men.
So it risks reinforcing the very inequalities we're trying to fix.
Precisely.
Okay, let's try to synthesize all this.
Yeah.
The AI boom seems financially more stable than the dot-com crash, but only because the risk is concentrated with these incredibly powerful hyperscalers.
And at the same time, it's structurally far more disruptive than even the Industrial Revolution.
More disruptive because of that unique ability to centralize value.
Yes. The Industrial Revolution, for all its pain, eventually led to broad societal gains. New infrastructure, new consumer products, and eventually labor protections like the Factory Acts. The system, however slowly, was designed to diffuse the benefits.
But the AI revolution, with its vertically integrated structure and uncapped, usage-based pricing, it seems designed to do the opposite. It's built to impede that diffusion of economic benefits.
By constantly capturing the surplus from the application layer.
So what does this all mean for you, the learner? We're on the cusp of this era of unprecedented productivity growth.
But that growth is happening inside a capital structure that seems almost perfectly engineered to concentrate all the resulting wealth into the hands of the very few who own the infrastructure.
We learned from the Industrial Revolution that inequality skyrocketed because income went to capital and land, not to labor.
So if the AI era is similarly designed for the hyperscalers, the owners of this new cognitive capital, to capture the vast majority of the economic surplus through their pricing models, how can policy, or even just market competition, possibly guarantee that these massive productivity gains will ever diffuse broadly enough to prevent a new age of structurally mandated inequality?
That really is the question that's going to define this decade.